presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for July 2nd, 2021. I'm Moe Ansari, President of Compak Asset Management and the Chief Investment Officer, host of Market Wrap. Don't forget to tune in to my daily broadcasts every day on most of these stations and on YouTube. You can also download the app and it will be automatically downloaded to your iPhone or Android phone, and you can listen to it at your convenience. I'm also on the move, finally starting to travel. It's wonderful to go and see and visit all of you. I will be back in the San Jose office and in San Jose live and in person. I'm not just a pretty voice on the radio that you hear every day, but I will be more than happy to sit down and talk to you. That's what I really enjoy doing. I will be in San Jose on the 8th and the 9th. If you'd like to meet, you can always make an appointment. Register now. You can simply click on the link below and you can make an appointment. It is absolutely free. And if you don't want to sit down in person, you just want to learn, we have a Lunch and Learn seminar that I will be doing on July the 9th. Right in San Jose also. It is free. You can click on the link below to make that appointment and reserve your free seat. July 21st is the global webinar that I will do. That's for everybody, all of you around the country and around the world. So many hundreds and hundreds when you log on every time we do that. I will do the next one on July 21st. Again, you can, if you'd like to find out about it, just go to the Compak website and it'll give you more information. And don't forget to subscribe to this update. Every time I do an update, you will get a notification that I have posted an update. Just click on the button and subscribe. Let's start with the data on the COVID. Well, it's a long goodbye. That's the way I would look at it. Slowly but surely, it is going into the past, something that we read about in history books, how terrible it was, how many people died, and we're looking at the hospitalization rates coming straight down. But that is here in the United States. The rest of the world still trying to catch up. Europe, which bungled the vaccination, are trying to catch up now, and then we are going to see the emerging markets finally when they get the vaccines. So I believe that we are going to see this recovery that we've seen here in the United States ricochet around the world. It's going to be wonderful to see everybody out and about, as I expect a lot of you will be out and about this July 4th. I'm looking forward to it. So finally, we are going. One thing that I noticed with this SARS, the Delta virus, the Delta strain of the coronavirus, it is not as contagious, not as deadly. That's the mortality rates, thank God for that, are much lower than the original strain. That is the good news. Even on unvaccinated individuals, it is much lower. And that is a very positive thing. More and more people are being vaccinated. And as we've seen the data on the Moderna and the Pfizer vaccine, it works very well against the Delta virus. Reopening, we're finally catching up. We're nearly 2 million people going through the TSA checkpoints. Hotel occupancy is up to about 68%. Pre-COVID was 75.4. We're looking at weekly retail sales. And that is one thing that I've noticed. The savings rates, which I'll talk about in the webinars and the seminars, have jumped up dramatically, historically, when you look at it. So we have a lot of pent-up demand, pent-up savings that people are going to spend all of that money. And that is coming out in retail sales and bodes well for the economy. As we know, 66% of our economy is consumption. We're looking at global commercial flights. Now, those are coming back up, but still about 28% lower. And that is because a lot of the countries have not vaccinated yet. You look at the reopening, we're sort of going sideways. That's what we have seen. Nothing dramatic. We have not gone, we're about at 84 to 86% of pre-COVID levels as far as the reopening trade. The big news this week was the unemployment data. 850,000 non-farm jobs created. The expectation was around 700,000 jobs. So that number was better than expected, but the unemployment rate went up from 5.8 to about 5.9. And that sort of had everybody puzzled with that many, 850,000 jobs. Why did the unemployment rate go up? Well, more people came into the workforce, and only 18,000 people dropped out of the force. So that is why the unemployment rate was up, and that is why the market reacted positively. It does not put any pressure on the Fed to raise interest rates in the short term. They will stay on course, expected to announce a change in policy at the next Jackson Hole meeting. That's where all the central bank heads of central banks get together in August, and they are going to announce the change, probably going to give us some definitive ideas of how the tapering, what the tapering will look like in December, and then start at about, I think, a clip of about 10 to 15 billion a month, where they're going to reduce the amount of bonds they're buying by about 10 to 15 billion a month. What the makeup and the composition will be, are they going to cut back mortgage-backed securities or treasury bonds? We'll find out. But I think by that time, the market will be pretty much used to it or expecting it, and it will be old news by the time they start that. Hopefully we'll get there and we don't get to a taper tantrum like we did when Mr. Bernanke, who was the chairman of the Federal Reserve, announced the last taper. Looking at the numbers, we are seeing payroll plus. I think that is really holding back a lot of people from going to work. If you look at the state numbers, we're about 3.5 million people, but we're looking at a lot of this other, which is in the red and the orange. That is the emergency pandemic relief that is being given to people, which is great news. But I think at this point, we really don't need, we need people to go out and get the jobs that are out there. We've got 9.3 million jobs available right now, which is a tremendously large number. But we are seeing a lot of people who are getting more money by staying home than going to work. And that is a disincentive. I think as we pare these back, these emergency plans, we will see more and more, and I think that'll get the unemployment numbers down again. Technically, I talked about the 4,300 number. Well, we are at 4,300. We closed at a new all-time high today. Wonderful to see. It's just the market just continues to move higher. That is the trend, and as the old saying goes, the trend is your friend. According to my target that I put out at the beginning of the year, which was 4,400, well, we're at 4,352 now, so we are very, very close to that number as of today's close. This is a daily chart. Each one of these lines is 1 day of trading, the green and red lines. This is the 20-day moving average, which is at 52.50. That is the first support area, and the blue line is 48.02, which is, if the market does start to come down, will provide support to the market. And this is the 200-day moving average, which is way a ways from the market. Now we go to a weekly chart looking back to 2017. This goes all the way back. Each one of these lines, these red and green lines that you see, is 1 day of trading. Everything moves in 5 waves, where you see 1 wave up, 2 wave to the downside, 3rd wave to the upside, and that's what we're in. Usually the 3rd wave is the strongest, which started last year after the pandemic crash that we saw here, and we're starting a new wave count. Target on this, again, 44.75. And then if we do get above 44.75, we are looking at 46.50. That could be the extension. I don't expect that to happen this year, maybe sometime next year, depending on how the economy revives, what we see with inflation, how much the Fed tapers. There's a lot of variables, but that is technically the long-term target that I'm looking at. Support on the long term is 42.22, then 4,000, then 39.35. That is the way I am looking at it from a technical perspective, the S&P chart in the Standard & Poor's. Let's take a look at the NASDAQ on the daily charts. I had a target of 14,750 that I talked about. Well, we're 14,639 today as of tonight's close. So a wonderful rally that we've seen in the market. Support now the 20-day moving average and the 50-day moving average. And if we do see an extension on this wave count, our target is 16,000 now for the NASDAQ. I know, seems like a big number, but that's only 1,500 points away from where we are today, or less than that, about 1,400 points away from where we are right now. But that's the way the chart is looking. Here's a weekly chart. Each line 1 week of trading, going back to 2017. Long-term target, again, 16,400 is the extension of the 3rd wave. Will we get there straight? As you've heard me say for the last 30 years, right before long weekends, don't ask me why, we see extremes in the market on the upside or the downside. Well, we are going into a long weekend, and we are at new all-time highs in the market. I would not be surprised for the rest of July to see a little bit more backing and filling in these markets. We've gone up a lot very, very quickly. We are seasonally in the weakest time of the year. July, August, and September are usually the worst months historically for the market, but that does not mean we sell everything and run to cash. That's not what I'm trying to say, but just being a little bit defensive, a little bit of pruning and planting, that's what you can do. If you do see pullbacks in the market, I would view those as opportunities to buy. So have your buy list ready. Looking at the gold market, very disappointing. After the Fed said they're going to start tapering, we went right through the 200-day moving average, which is this magenta line right here. 1832 is where is the 200-day. We broke right below it, came down to about 1750. That has become support, and the next support is about 1670 or 1675. The market has to really get going and get above this 200-day moving average. Our target, there's a double top right here at about 1960. That's what I look at as resistance, but the market has all the opportunities. We've seen interest rates come back down. We've seen inflation fear subside. Interest rates come down. The dollar has sort of held its own, but the gold market has not gone anywhere. And as I've said over the last 30 years on the radio broadcast, when you get good news and a market does not go up, watch out for that market on the downside. The emerging markets sort of going sideways. Again, I think we need to get the vaccination going. Once we get the vaccination, much more higher numbers of vaccination in the emerging markets, that's when I think we see the rally back to about 62, which could be a substantial rally, about 20% from where we are right now. I expect that to see that in the next 6 months. The small cap or the reopening trade still stuck in this range of about 2360 to 2100. Just go back and forth. We got very close last week, then we drop back down. If we can break out above it, then my target becomes 2500, and that will really reinforce the reopening trade. Small cap is where the reopening trade is. As the economy opens, the small cap, smaller companies are going to benefit more. The large technology companies benefited during COVID, but I think now we are going to see more of the small caps once we get more reopening. But it's been stuck here since the beginning of the year in this range. I would like to see a breakout above this and start moving to the upside on this. On the weekly charts, again, very similar picture. This is the shelf of resistance. We are going back and forth, 2160, 2100. If we can break above 23, I expect 24, 25. Longer term target, 2850, substantially higher than where we are right now. But we have to see this recovery really gaining momentum here in the United States, in Europe, and then in the rest of the world for the small caps to do well. That is my views. Those are my opinions. That's the way I'm looking at the markets this long weekend. Again, don't forget July 8th and 9th, I'm going to be in San Jose. That's next week. If you'd like to meet with me, just click on the link below and set up an appointment, and I will review your portfolio. We'll take a look at where you are financially and where you're headed, and then we'll get a roadmap for you. If you want to come to the seminar, that's July 9th. It is also free, and you can go again. Just go to compak.com and register. And if you'd like to come to the global webinar that I will do, that's not in person, it's a webinar, still doing those, that'll be on July the 21st. Have a wonderful long weekend. Thanks for joining me today. I'm Moe Ansari. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.